Part 2. The magic of retained earnings. Retained earnings denote net income which a firm reinvests for its operations. Hence, in this case, the company doesn't rebuy shares or pay dividends. Retained earnings are a part of stockholders' equity in the balance sheet. Shareholders' equity grows when retained earnings accumulate. Buffett feels firms with high retained earnings have a lasting edge over rivals. He runs an investment holding firm, Berkshire Hathaway. This publicly traded firm doesn't pay any dividends. Such a policy has helped the firm amass vast amounts of retained earnings. This adds to long-term growth in the company's value. Buffett favors rebuying stocks to paying dividends. This is his way of rewarding the shareholders. When it buys back its shares, the firm increases its EPS. And as EPS grows, the share price also increases. The tax charge is another significant factor. If Buffett got dividends on his company's share, he'd need to pay income tax. Instead, he collects capital gains on his shares tax-free. As long as he keeps the shares. Already, he has amassed $64 billion of unrealized capital gains on his firm's shares. And he hasn't paid any tax on such paper gains. Buying, holding, and selling equity bonds. Berkshire invests long-term in firms with strong competitive edges. Hence, it owns shares which act as bonds with returns which increase over time. Buffett names such shares equity bonds. The return on such a bond is the firm's EPS. And as EPS increases with time, so does the return on the equity bond. For example, in the late 1980s, Buffett bought shares in Coca-Cola. He bought these for $6.50 per share. At this time, the firm had yearly earnings of 46 cents/share. This, for Buffett, equated to an initial return rate of 7%. By 2007, Coke was earning $2.57/share. This meant a 39.9% return on his initial investment. Buffett invests long-term in firms having a lasting competitive edge. It's because the longer one holds them, the better they do. But, 3 kinds of situations make selling a good share worth it. First, if sale proceeds can finance a better investment. Second, if the firm is giving up its competitive edge. And, third, if the share price increases. In an overactive bull market, if the share price is 40 times greater than yearly EPS, sell it. But, don't buy another stock trading at 40 times its EPS. Instead, keep this cash and wait for the market to settle down. Wait till good equity bonds become available at low prices. Yes, Buffett's investing style needs patience. But the payoff is remarkable. Mary Buffet and David Clark provided the full summary of all the key points related to the financial statements and future performance of the firm in their summary of Warren Buffett and the interpretation of financial statements. The book was really helpful for the beginners, and they have the opportunity to learn about the financial records, computed ratios, and smart tips for the investment. The durable competitive advantage can be generated through the investment strategy and become a great fortune for the investor. The objective of the book was to make the reader able to learn about income statement, balance sheets, and cash flow statement with a precise explanation. We had found some interesting points when we were reading the book. The book showed durable competitive advantages, and some hidden treasures were unearthed by the author. The factual learning was great about novice investors and traders. The book elaborated competition in the business and strength of financial statement for the reader. The conclusive points were secretly discussed so the reader cannot reach to gems, but in fact, he is required to understand the lines mentioned in the book. Both authors inspired me by interpretation of all the quotes, anecdotes, and financial statements. Being a potential reader, we discovered the effect of development cost as it becomes dangerous if the company keeps it as debt. The selling prices can be low for the company, as Buffett explained, but the identification of perfect investor in the business is crucial. In the book, Buffett preferred firms of high grade. Along with the steady cash flows and focus of his portfolio, was on the few stocks. We were reading the book and found the significant fact for the tax charges and income tax that was quoted by Buffett as the place that Warren goes to discover whether or not the company has a durable competitive advantage is its financial statements. Key takeaways: Buffett invests in high-grade firms having a strong competitive edge. He likes businesses whose products/services are unique, or businesses which sell their products/services at the lowest price. Cash flow and income statements and balance sheets show a company's potential. Firms having steady net incomes at 20% greater than or equal to of revenues are industry leaders. Don't invest in firms having high expenses for interest, research, and depreciation. Firms with a strong cash position and little outside debt pass troubled times easily. Buffett likes firms which create retained earnings. He has $64 billion in unrealized capital gains. These gains are on shares he owns in Berkshire Hathaway. Buffett views shares as equity bonds with growing yields. Think of selling any share whose price is 40 times more than its EPS. Warren Buffett and the interpretation of financial statements quotes. Warren Buffett has learned that time will make him super rich when he invests in a company that has a durable competitive advantage working in its favor. The place that Warren goes to discover whether or not the company has a durable competitive advantage is its financial statements. When Warren is looking at a company's financial statement, he is looking for consistency. Warren knows that one of the great secrets to making more money is spending less money. Warren has learned over the years that companies that are busy misleading the IRS are usually hard at work misleading their shareholders as well. While the total revenue number alone tells us very little about the economics of the business, its ratio to net earnings can tell us a lot. Making chewing gum is a much better and a far more profitable business for shareholders than making cars. The place that Warren goes to discover whether or not the company has a durable competitive advantage is its financial statements. Warren Buffett has learned that time will make him super rich when he invests in a company that has a durable competitive advantage working in its favor.